Did you know that even a 20-point jump in your credit score could save you thousands of dollars when you buy a home? I see this all the time. People think they can't qualify, when in reality, with just a few smart moves, they could raise their credit score and open the door to home ownership. In this video, I'm going to walk you through two things. The first is 5 practical steps you can take to strengthen and rebuild your credit. The second is 11 common myths about credit repair that hold people back and the truth you need to know about those. But before we dive into those, let's talk about the why. Why does your credit score matter so much in the first place? A lot of people think it only affects the interest rate, but it can also change how much you have to put down. To make this real, let's look at an example. Let's look at a $400,000 home and compare 3 scenarios side by side. You'll see exactly how credit influences the down payment, the loan amount, and the monthly cost, which will hopefully help you realize why it's worth taking action now to get your score up. So in scenario 1, we're going to show you kind of the best case scenario here. This assumes a home price of $400,000, a down payment of 3.5% or about $14,000, a loan amount then of $386,000, an interest rate of 6%, and monthly principal and interest of $23.14 a month. Scenario 2 assumes lower credit, and so let's see how this affects it. You then have a home price of $400,000, down payment of 3.5% or $14,000, same loan amount of $386,000, but the interest rate this time is at 7%. This makes the principal and interest payment $25.68 a month. The last option, scenario 3, is assuming even worse credit, which then not only affects the interest rate but also the down payment. So in this scenario, you have a home price of $400,000 again, down payment of 10%, or about $40,000, a loan amount of $360,000 with an interest rate of 7%. This puts the monthly principal and interest at about $23.95 a month. So let's go over some of the takeaways from this. With the same down payment in scenarios 1 and 2, the higher rate ends up costing about $254 a month. And even in the lower credit score option, where the borrower ends up putting $26,000 more down, they still pay more per month than the higher credit score in scenario 1. This really underscores that credit isn't just about approval, it's about saving both cash up front and money every month. So you can see the impact. Higher credit means lower down payment and lower monthly costs. The good news is credit is not permanent. You can improve it, and often faster than you think. Let's walk through some of the most important and effective steps to start repairing your credit and getting it mortgage ready. Step number 1 is check your credit report. You'll want to go to a site called annualcreditreport.com. This is the site where you can check your credit report free from each bureau once a year. What you'll want to do is look for errors, wrong balances, closed accounts that are showing open, late payments that aren't yours. You'll want to then dispute these mistakes, because removing errors alone can bump your score up. Now let's talk about collections that may show up on this credit report, because really this is a big one. If you've got accounts in collections, the goal isn't just to pay them off, it's to get them deleted. Now let me repeat that. The goal is not just to pay them off, it's to get them deleted. Many times you can negotiate a lower payoff amount with the agency, and if you get it in writing, even better. After you've paid, you can ask for what's called a pay for delete, which means the account comes off your report completely. Not every agency will agree, but here's a little trick. Once the account is marked paid, you can then often go into the credit bureaus and dispute that collection. And because the agency has now already received the money for that, they often won't fight you. That's how you can then get that collection removed. And that's when you start to see your credit scores really jump. Because collections are often one of the main reasons people's credit scores are lower, I want to go through the 5 steps of getting rid of these collections. Number 1 is negotiate the balance. Collection agencies often buy debts for pennies on the dollar. That means you can sometimes settle for 50 to 70% of whatever the balance was. Always try to get the agreement in writing before you pay, but again, you may not always be able to. Number 2, step 2 is pay for delete. Now again, this is the best case, because again, ideally you're going to want the collection deleted from your report, not just marked as paid. Some agencies will agree to do this upfront. Others will not, and they'll just mark it as paid or settled, which is better than unpaid, but the negative history still lingers. So that leads me then to step number 3, which is dispute after you make the payment. Once it's marked paid, the agency has no incentive to keep reporting it. If you then file a dispute with the credit agencies, the collection company won't bother fighting you on it. The result is that the collection might be removed entirely. Step 4 is why deletion even matters. A paid collection is still a red flag in the scoring system, but a deleted collection can remove the weight altogether. That means it can be a really big jump in your score, especially if it was a recent collection. Step 5 is timing and patience. After paying and disputing, it can still take about 30 to 60 days for these changes to reflect, but you'll want to always check your credit report after to confirm it has been deleted. Okay, so step 1 was checking your credit report. Now we're going to move to step 2. Step 2 is pay down your credit card balances. This is because your utilization of your credit cards makes up about 30% of your credit score. And the word utilization is just a fancy word which simply means how much of your available credit you are using. Good rule of thumb is to keep every credit card under about 30% of its limit. And if you really want to maximize your score, aim for about 10%. So for example, let's say you have a credit card with a $1,000 limit. You don't want the reported balance or the statement balance to be more than $300. And if you can keep it under $100, that's even better. Now here's the part that most people don't realize. Your balance changes daily as you pay and use your credit card. But the credit bureaus only see the balance reported once every month. This is usually your statement balance. That means if your statement closes at $800, that's what gets reported to the credit bureaus, even if you end up paying that off in full the next month or the next day. In that scenario, you'd be using about 80% of your utilization, 80% of your credit limit. So here's a quick tip of how to work around it. Pay your balance down before your statement date, not just by the due date. You can also spread purchases across many different cards, not just one single card. That way that one single card doesn't look maxed out. And here's a pro tip for you. If you don't have the cash to pay down your balances, sometimes you can request a credit line increase. What I mean by this is, for example, let's say you have that $1,000 credit card, you can try to raise that limit from $1,000 to $2,000. That would then instantly cut that same $300 balance from a 30% utilization to a 15% utilization. The key takeaway to all of this is that the lower the reported utilization, the better your score. And it's one of the fastest ways to see improvement. Step number 3 is never miss a payment again. Payment history makes up the biggest part of your credit score. It's about 35%. Even one late payment can drop your score by 50 to 100 points, and it can stay on your report for up to 7 years. So how do you make sure this never happens? Number 1 is set up auto pay for at least the minimum payment. Even if you can't pay the full balance every month, paying the minimum on time keeps your history clean. A second idea is use reminders or alerts in your phone or banking app a few days before the due date. A last step is align the due dates with your paycheck schedule. Most credit card companies will let you move that date so that it matches when the money actually comes in. Here's a quick example for you. Let's say your minimum payment is only $25. If you miss it, you could get hit with a huge $40 late fee, a penalty interest rate, and a 70-point score drop. That's a huge hit for such a small payment. AutoPay will help you avoid that. A pro tip is if you're already behind, once you've caught up on your payments, you can sometimes call your lender, the credit card company, and ask for what's called a goodwill adjustment. This is where they agree to remove a recent late payment as a courtesy to you, especially if you've been on time for a long stretch before. Not every lender will do this, but again, it never hurts to ask. And if they say no, keep pushing forward with consistent on-time payments. The impact of old late payments will gradually fade with time, as positive history will gradually outweigh the negative history. Step 4 is don't close old accounts. This fourth step is simple but very powerful. Why? Because the length of your credit history makes up about 15% of your credit score. Lenders want to see that you can manage credit responsibly over time, not just in the short term. Think of it like this. If you had a credit card for 10 years and then you close this credit card, you're cutting away a whole decade of positive history. That can then shorten the average account age, which would then cause your score to dip. So here are some ways to handle old accounts wisely. If you don't use an old card often, just put a small charge on it once in a while, like gas or a subscription, and then pay it off. This just keeps it active. If the card has an annual fee, call the issuer and ask if they'll downgrade that card to a no-fee version instead of closing it. Now keep in mind, closed accounts can still stay on your credit report for years, but they do eventually drop off. So it's better to keep them open when possible. And here's a pro tip for you. Old accounts with zero balances and no late payments are like anchors for your credit score. So closing them early is like pulling up those anchors, which then would lose some of that strength. The bottom line is, unless there's a good reason, just hang on to those older accounts. They're quietly boosting your credit score in the background. Step 5 is build positive credit. This fifth step is all about adding fresh, positive credit history to your report. Because if you've had mistakes in the past, the best way to move forward is by building new, consistent, on-time payments. So here are a few simple ways to do that. Number 1 is a secured credit card. The way these work is you put down a small deposit $200 to $300, and that becomes your credit limit. Then you use this card just like a regular credit card, keep the balance low, and pay it off in full every month, and it reports positive credit history to the credit bureaus. Another one is a credit builder loan. Some banks and credit unions offer these. Basically, you make a small monthly payment, like $25 to $50, and at the end of the term, you get your money back. Meanwhile, those on-time payments are then reported to the credit bureaus. Another option is being an authorized user. Let's say you have a family member with strong credit. If they add you as an authorized user on one of their old, well-managed accounts, their good history can then reflect onto your report. Just make sure that that credit card has no late payments and low utilization. A pro tip is keep the new account small and manageable. The goal isn't more debt, it's more positive credit history. 1 or 2 good trade lines paid on time every month can rebuild trust with the credit system faster than you think. Remember, your credit score is really just a trust score. The more you show lenders that you can handle credit responsibly, even in small amounts, the more that trust grows, and the better your options get when it's time to buy a home. Now that you've got all 5 steps fully built out, let's go ahead and review those 5 steps. Number 1 is check your credit report, and in that section we talked about collections and the strategy that goes with that. Number 2 is pay down balances. So we talked about utilization, statement balances, and credit limit tips. Number 3 is never miss a payment, and we talked about possibly doing those goodwill adjustments. Number 4 is don't close old accounts. That way you can keep your history working for you. And number 5 is build positive credit history, and we talked about secured loans, builder loans, and authorized users. So those are the 5 steps to repairing bad credit. Remember again that every 20 to 40 points that you raise your credit score can mean thousands of dollars in savings when it comes to buying a home. If you're curious where you stand right now, take our 60-second home buyer quiz. The link is in the description. It'll show you exactly where you're at and the next steps to take. The point is, don't let bad credit hold you back. Start today, take these steps, and put yourself on the path to owning a home. Now, before we wrap up, let's clear up some of the biggest myths I hear about credit. There's a lot of bad information out there, and I don't want you wasting your time on things that don't actually move your score. So let's go ahead and bust some of these myths. Myth number 1 is opting out of pre-screened offers will boost your score. Sites like optoutprescreen.com are great for stopping junk mail and protecting you from identity theft, but opting out doesn't actually raise your score. The only benefit is fewer tempting offers that could lead to new debt or hard inquiries. Myth number 2 is checking your own credit score will hurt you. This is false. When you check your own credit score through apps or directly with the bureaus, it's a soft inquiry and has zero impact on your credit score. Only hard inquiries from actually applying for credit can then drop your score. Myth number 3, paying off a collection automatically removes it. When you pay a collection, it usually just changes it to paid collection, and that can still hurt your score. The better move is to negotiate a pay for delete, or after payoff, dispute it. Many agencies won't fight it once it's been settled, so it may then get removed completely. Myth number 4, carrying a balance helps your score. Nope, this one's not true. You do not need to carry a balance to build your credit. You can use your card, pay it off in full each month, and grow your score without paying a dime of interest. Myth number 5 is closing old accounts will help your score. Actually, as we've talked about earlier, closing your old accounts can actually hurt your score. It hurts you by shortening your credit history and raising your utilization ratio. So unless there's a big annual fee, it's usually better just to keep those old accounts open. Myth number 6, you have to use your credit cards all the time. This is not true. As long as the account is open and in good standing, it still reports, even with a zero balance. To avoid the issuer, the credit card company, closing that credit card for inactivity, just put a small charge on it once every now and then obviously make sure you pay it off. But again, you don't even have to use these credit cards to build credit. Myth number 7 is shopping for a mortgage can ruin your credit. Credit bureaus know people shop around. All mortgage inquiries within a 30 to 45 day window count as just one inquiry. So don't be afraid to compare lenders. One inquiry won't tank your score. And obviously finding the best rate could save you thousands. Myth number 8 is that opening multiple credit cards always helps your credit. The reality is not at first. Opening several accounts in a short period of time will typically drop your score by lowering your average account age and also adding multiple hard inquiries. Long term, if you manage them well, they can of course help, but don't open a bunch of new credit cards right before applying for a mortgage. Myth number 9 is all that matters is paying on time. On-time payments are the biggest factor, but credit mix matters too. About 10% of your score comes from having both revolving line of credit, like credit cards, and installment loans, like auto or mortgage loans. This shows lenders that you can handle different types of debt. Myth number 10 is after bankruptcy or perhaps bad credit, it's safer to avoid credit completely. The reality is I understand this fear, but avoiding credit altogether means you'll never replace old negative history with new positive history. The only way to rebuild is by adding on-time, fresh payments. So use credit wisely and don't avoid it. Myth number 11 is you have to pay a credit repair company to fix your credit. The truth is, credit repair companies don't have any magical tools. Almost everything they do, like disputing errors, negotiating with collectors, or setting up payment plans, you can do for yourself, often faster and for free. This doesn't mean that all credit repair companies are scams, but many charge high fees for things you could probably knock out on your own with the right guidance. Really, that's what this video is all about. If you follow the steps I've shared, checking your reports, lowering your utilization, handling collections, building new credit cards, you'll already be doing the most powerful steps you can do without having to pay anyone. So if you've heard these myths before, now you know the truth. The real drivers of your scores are simple. Keep balances low, pay on time, protect your old accounts, and build positive history. Do those things, and your credit will get stronger over time.